Welcome to another episode of the Doctors Building Wealth podcast. Today we're going to be talking about some of the hidden risks of short-term rentals and how you can avoid them. And we're going to really focus on some of the three most common mistakes that we see people make and give you actual solutions so that you can avoid them and you can have a profitable short-term rental that, runs for you for years to come.
And before we dive in, I think it's important to define what a short-term rental is. And so I'm going to use the IRS definition of a short-term rental, which is when you rent a property out and the average stay is 7 days or less. When that happens, the IRS lets you use that short-term rental as long as you meet certain criteria, let you use that short-term rental to create a tax shelter, which allows you to then shelter your active income. It could be W-2 income, 1099 income, maybe partnership income, any type of active income. And that's a huge benefit.
Yeah, there's a lot of reasons people love short-term rentals in our community. One being that it's easier to access the short-term rental tax loophole and be able to shelter the active W-2 income, your 1099 income, or business income from taxes. But another one is short-term rentals oftentimes can have higher cash-on-cash return than long-term rentals. And so it's very common in our community that people are aiming to get 15 or even 20% cash-on-cash return per year with their short-term rentals. So they'll have, even with one short-term rental, a lot more cash flow per year than they would for an equivalent long-term rental. And another benefit is people love vacation homes. They love the idea of having a vacation home. They can use it, when it's not booked, or even they could maybe even put side time on their vacation home every single year for their family to have a gathering place. And so those three big benefits, tax savings, higher cash and cash return, and an opportunity to be able to use it for personal use, are really attractive to people. So that's why they tend to love short-term rentals. But what we don't like to see is people get into trouble with their short-term rentals. And so we think a lot about risk mitigation. And so we really wanted to do this episode where we talk through some of the most common, stress points people have and how to mitigate risk and make it less likely that you run into those problems with your short-term rental.
Yeah, and I wanted to talk about risk mitigation. And so I think of it in two parts. I think most people kind of think of risk mitigation. They'll say, okay, well, what are all the different risks? I need to be aware of the different risks. And that's important. And you absolutely want to make sure that you identify all those risks. And most people have blind spots. In other words, they don't know what they don't know. And so one of the best ways to do that, and we do this in our community, is to ask other people, hey, what am I missing here, right? And that's kind of how you can make sure you don't miss any of those risks. But assessing those risks is one part. The other part that is, I think, even more important is to take action so that you can mitigate the risk, right? And that's something that we like to do, not only identify the risk, but also take action to lower the risk, right? And then we call that risk mitigation. And again, I wanted to kind of make sure that you understood that there's really those two parts of it. And when we talk about risks, we're going to talk about risk, but we're also going to be talking mostly about how to mitigate risk.
Yeah, and the three main things we're going to focus on this time are low cash flow, running into that problem, having problems with STR regulations, and issues with the workload. So those are the three we're going to focus on, and we're going to talk to you about how to mitigate risk for each of those. So let's jump right into lower cash flow than you planned. So how are the ways that you can plan and actually predict how much you're going to cash flow and actually end up with that cash flow? Well, number one is using a cash on cash calculator, really looking at all those assumptions in the cash on cash calculator and making sure they're accurate. So a cash on cash calculator is a tool that us real estate investors use to be able to predict how a property is going to cash flow, how it's going to make money after all expenses at the end of the month. And cash and cash return is a measure we use when we're looking at how much cash we're putting into the property, in the down payment and any rehab, for example, that we're doing. And we want to know the return we're going to get on that money each and every year of the property. Now, this cash and cash calculator, by the way, we have one in our website. So if you go to semiretiredmd.com and you look for our short-term rental cash and cash calculator, you can definitely get our version of it. The cash and cash calculator is only as good as the numbers you put into it. So one of the ways you can mitigate risk of having lower cash and cash return than expected is you actually put the right assumptions in and you have team members verify those assumptions.
Yeah, and there are so many different variables, and I think that team members is definitely one source, but you also want to make sure that you look at other sources as well, and that's one way you can mitigate risk. Of course, you can go to your team member and they'll give you a number, but the question is, how accurate is it? How conservative is it, right? These are some of the questions you might want to ask, and one way that you can test those questions is to go out and find other sources, right? You might ask maybe people who are not your team members. Maybe you'll ask other property managers, right? Maybe you'll ask other investors. Maybe you'll go out and look at data. There's a lot of great data sources like AirDNA or Mashvisor that will give you data that you can use to plug into your cash-on-cash calculator.
Now, I wanted to draw two assumptions that we put into our cash-on-cash calculator to make it more conservative. So we're very likely to actually perform even better than we expect. So specifically with short-term rentals, and actually we do this with long-term rentals, we always put in property management expenses. And with short-term rentals, that can be 20, 25, 30% cost to have a property manager. Now, even if we're assuming that we're going to self-manage, we want to know that the property is going to cash flow well with a property management in place, because you never know if something's going to change. And you don't ever want to be in a situation where you're forced into self-management, or you buy a property, you hire a property manager, and all of a sudden you're cash flow negative. That means you have a liability in place. So we always run our numbers, our cash and cash calculations, with a property manager in place and those costs. And then if we don't have a property manager, we're going to perform that much better. And so now we're less likely to get into the situation that we're not cash flowing as expected. The next one we often do with short-term rentals is we put in higher maintenance costs than normal. And that's because with a short-term rental, you have furniture, you have a lot of tenants going in and out, and so you're much more likely to have maintenance issues. You're using a lot more utilities, you're using, that furniture can get damaged. So you want to factor in additional maintenance than you would with a long-term rental. And again, if you don't have anything break, or something breaks and is covered by insurance, great, then you're not going to be using all that extra percentage that kind of built in as a buffer, and you're going to perform better than you expected, and so you won't run into this situation of low cash flow.
Yeah, I think being conservative with your numbers is a really great way to mitigate risk. I wanted to introduce another way to mitigate risk, which is to make sure that once you buy the property, you don't just set it and forget it. Mm-hmm. And I think that's what a lot of people tend to do, is that either they'll self-manage that first year, or they'll hand it off to a property manager, and they just kind of completely forget about it. And then they get these statements and they're like, man, this property is not performing as well as I expected. And so what you really want to do is you want to stay active. You want to really stay active in terms of thinking about ways to increase revenue and decrease expenses. Mm-hmm. And you want to constantly be thinking about ways to do that. And really, there are an unlimited number of ways that you can do that. I can just give you one example here, is that you can actually create a direct booking website. That could be one way that you can increase revenue. One way that you can decrease expenses is you can put in, let's say, a thermometer that turns off when their guest's not there to lower your utility costs, right? And these are two simple ways to do it. Now, there are probably hundreds of ways that you can increase revenue and decrease expenses, and it's probably going to be different for every single property. And so you really want to think about your property. You want to be asking these questions, and that's one way that you can mitigate the risk, because what you're doing is you're driving up the cash flow over time by improving that revenue and decreasing expenses by implementing all these different ideas that you come up with. And again, that's one way that you can actively lower your risk.
And then lastly, we want to mention, in our community, we aim to be in the top 10% performance in our markets. And so we do that by looking at what else is available, looking at the highest performing short-term rentals in our markets. What kind of amenities do they have? What kind of decoration do they have? Where are they located? And we're really aiming to buy short-term rentals that are going to be in that top 10% performance, and to get our properties there over time. Like Kenji mentioned, we're always looking to improve our properties, increase income and decrease expenses. And so when you're aiming to be in that top 10%, you're going to likely perform much better than anticipated, right? Because you're not going to be in the middle of the pack. And a lot of cash and cash calculations, we always build in multiple scenarios, like a low, middle, and high scenarios. But a lot of us are kind of looking at that middle scenario and saying, okay, does this work if we stay in that middle? But ultimately, once we, again, buy that property, we're aiming to be in the top. And that would help you mitigate that risk of getting less cash flow than you expect when you purchase that property. Now, the next one that we wanted to talk about is STR regulations changing, because this is a real risk. We can talk about how we've personally dealt with this, both in markets, but also with HOAs where STR regulations change. How do you mitigate that risk?
So let's start out with city regulations. I think one of the things that you can do is you can choose a market that already has well-established regulations.
Yeah, and that's what we tend to do, is to look for markets where they're already making money. The government's already making money from short-term rentals in place. They're collecting taxes, and then they have had a long history of having short-term rentals, dozens and dozens of years, maybe longer than that, where it's very, very common practice, and it's very unlikely that it's going to have a dramatic shift because it's been that way for so long. Now, most people would think, I want to go to a place that has no short-term rental regulations. I could just go out and I can buy any property and I'm going to be able to turn it into a short-term rental. What we're saying is exactly opposite of that, right? You want to go to a place that actually has well-established short-term rental regulations where the government is collecting fees. And that's because you're very unlikely to have a sudden short-term rental complete ban because there's history there. Whereas if you go somewhere that doesn't have any regulations at all, you could be in a situation that a couple years from now, there's a complete short-term rental ban and you're in a tough situation.
And that's actually what happened to us in Dallas. We have a short-term rental there, and we did not expect there to be a ban. But sure enough, the city passed a ban, and we've obviously adapted to that. There was a lawsuit from short-term rental owners, and then it's been about 2 years now. And I think the short-term rental owners are winning that battle at this point, and we've been able to operate our short-term rental. But at any point, the city council could end up winning, and then short-term rentals could be banned in Dallas.
Yeah, so definitely buy in a well-established area with short-term rental regulations, and always make sure that you're compliant as well, right? Make sure you get your permits, make sure that you really understand the rules. Maybe you need a handyman who's willing to be a local on-site boots of the ground. There are all kinds of regulations. You want to make sure you're really compliant with them. You don't want to be in a situation where you're operating an illegal short-term rental and you get fines or you get completely shut down, right? That's not going to help your cash and cash return and your cash flow. You want to make sure that you understand the rules and you are following them, but you also want to be a situation, if there is a short-term rental ban, that you can exit effectively. And so one of the things we always do in our community is we always think about the exit. Now, most of the time, if you're buying a short-term rental that's a single-family home, you're likely to exit to a primary home owner who wants to buy that property. Maybe you're going to sell it to a short-term rental owner, but in the effect that there is a short-term rental ban, you're going to be selling it to a primary home buyer. So you want to make sure that you're adding value to that property so that it's worth more to that primary home buyer. So you're going to be very thoughtful about if you're doing any rehab or doing any upgrading, thinking through, is this going to add value down the road that I'm going to be able to sell it for more to the primary home buyer? And a thing like a temporary amenity, like a coffee bar, that's not going to help you, right? You have to really think about structurally changing the building or changing the outside landscaping or the outside living space to be able to add value. We call that forcing appreciation. And it's one of the things that we really do to mitigate risk, to not be in this situation that we can't exit a property if there is a short-term rental ban. So to give you a sense of that, this Dallas property that we have, we forced appreciation. We added a pool to the property. Even though it was a beautiful property when we first bought it, we can now exit that property for much higher than we purchased it initially because we forced appreciation. And so if the ban does go through, we'll be able to sell to a primary home buyer at a higher price than what we originally purchased that property for, and we'll make a profit.
Yeah, I mean, one of the worst feelings is to buy a short-term rental, you're operating it, and then all of a sudden there's a ban and you can't use it as a short-term rental. And this is what happened to a couple and in our community, and this has happened to a lot of people in the community. And what they've done is, luckily, they had a backup plan, and they were able to exit. So this is a great example of a couple who bought a property for $650,000 in a popular vacation area, and they already had a plan to force appreciation. They were going to make significant improvements to the interior, but they were smart upgrades. They didn't spend a lot of money, actually, but they took it from a dated property to really stunning modern design, and it looked really amazing. They also had a plan to put in a pool. And again, this was a market where a pool was a premium, right? It was that type of climate where a pool would add a lot, and a lot of homes there actually had pools. What happened with them was that when they bought the property, there was a temporary COVID ban that prevented short-term rentals, but the city council assured them that this ban was only temporary and that they were going to lift the ban soon. But sure enough, after they bought the property and they started fixing it up, the city council made that ban permanent. And so what happened was they couldn't rent the property as a short-term rental anymore. But luckily, they already had a plan to force appreciation, so and they didn't know what they were going to sell it for. But what ended up happening was, again, they bought it for $650. They ended up selling it for $1.3 million after these improvements, and so they made money. They took all that money, they 1031 exchanged, which is a tax-deferred exchange. They 1031 exchanged into 2 fourplexes in a different market. So again, they didn't lose money on this deal because they had an amazing backup plan.
Yeah, I wanted to also cover, if you're buying in an HOA, just to things you can do to mitigate risk there. Make sure you're reading the HOA documents and really understanding them. And another thing you can do is make sure that it's an HOA-friendly place, that some people on the HOA board own short-term rentals in that building or that area themselves, right? That's going to increase the odds that your HOA is going to stay short-term rental friendly for the near future anyway, at least until those members leave the HOA. That's going to give you a little bit more security in the fact that you're going to be able to maintain that short-term rental and for a number of years going forward. Now, not a guarantee. You still want to be doing things like forcing appreciation. You still want to make sure that you're being a great neighbor, but that could help increase the odds that you don't have problems with that HOA.
Yeah, and something else that you can do that we did was we actually lived next door to the president of the HOA, right? In one of the
we had our short-term rental next door. We didn't live there.
That's right. Yeah. So the president was next door to our short-term rental, and so we just became friendly with him. We also made sure that we communicated all the things that we were doing to make sure that we were responsible short-term rental hosts, right? We were making sure that there were no parties, making sure that there were quiet hours so they didn't disturb the neighbors, make sure that the guests were informed where to park and not to block the driveway, those types of things. And so, again, we wanted to make sure that the HOA board president knew what type of short-term rental owners we were and that we weren't going to cause problems. And so that's another way that you could potentially mitigate risk. Doesn't mean that's going to eliminate the risk completely, but it could potentially help mitigate that risk.
Yeah, relationships are always extremely important in real estate. And in this case, with that property, we forced appreciation and we actually exited it. And then the next one is to buy properties that are in commercially zoned areas. And this is one people don't really think about very often, but short-term rental regulations for cities oftentimes are really relevant for single-family homes or properties that are zoned residential. And so one potential loophole or carve-out can be if you own a property in a commercially zoned area. Now, sometimes this can be 5 plexes and above. Sometimes it could be even a single-family home that's in a commercially zoned area. But if you buy those types of properties, if there's changes in short-term rental regulations, you may not have any difficulties because you're commercially zoned, so you're considered a business area, and so it doesn't affect you. Now, this is going to be a really important one that you want to make sure you understand the local regulations, that you kind of dig in here, that you have a great investor-friendly agent who really understands short-term rentals in your area. But we've seen people in our community go and buy these commercially zoned properties and have short-term rentals that are really successful, especially in places where there are really limited permits for short-term rentals, and they didn't need that kind of stuff because they were commercially zoned. Okay, the last one we wanted to talk about, which is, again, an issue that we see short-term rental owners run into and that you can mitigate, is workload. Short-term rentals are oftentimes more work. You're a host, but people want to avoid having too much work, right? They want to continue to be able to work full-time at their day job. So how do they avoid some of that work and that long-term work with a short-term rental?
Well, one way you can do that is you can hand your property off to a property manager or a co-host.
Right. So the first year in our community, many people want the 100 hours or more, and more than anyone else, because they want to be able to make the losses from their short-term rental, the depreciation from their short-term rental, active losses to shelter their W-2 income from taxes. Well, the second year, you may not really care because you've taken and front-loaded so many of those active losses. The second year, you're very likely to show a profit on your short-term rental. And in those cases, what we see is a lot of people, and this is also what we've done in the past, we give our properties to property managers or to co-hosts that second year. And all of a sudden, we have a lot less work with that short-term rental with the day-to-day, right? We're no longer dealing directly with guests. We're not dealing with a lot of the maintenance issues. And the cool thing is that frees us up to be able to go buy that next short-term rental instead of worrying about managing that first short-term rental.
And it goes back to that first point, why you want to build in the property management costs into your cash on cash, because again, you need some type of release valve, right? If the work becomes more than you anticipated, or the work becomes something that, you just don't want to do, right? Maybe you don't love hosting. And if that's the case, then you want to have an exit plan for that. And so one exit plan is to have a property manager and co-host. And something else that we teach in our course is that you want to identify some of these people that you could hand it off to, even if you're not going to use them, identify them and build a relationship with them. And so that you have that kind of release valve, you have somebody to hand the property off to.
Yeah, I just don't think most people are aware of the fact that you do not need to self-manage long term, right? And so, again, be aware that if you're really aiming for those tax benefits, the most important year is that first year. And so the second year, maybe you become a passive investor and you have a property manager or a co-host doing a majority of that work.
Now, if you do self-manage, like I self-manage one of our properties, then there are a number of things that you can do to significantly lower the workload. One thing that you can do is you can automate a number of tasks. And so there are a lot of great software out there, property management software, that will allow you to automate a number of important steps. So for example, like guest check-in, checkout instructions, all those things are things that can be automated. And so you want to kind of run through all the different things that you are doing in property management, and then you want to see like which ones of these can be automated. There are also a number of things that you can potentially eliminate, and so that's another kind of important step, is like kind of run through all the different steps and say, what can I eliminate? And that also will save you some time. And then the last thing that you can do is you can think about things that you can delegate. And so one of the things that a lot of people in our community do early on is that they go out and hire a virtual assistant, and they train that virtual assistant to take on a lot of the day-to-day tasks, especially the rote tasks that are kind of like things that, again, don't require like direct guest communication, things like that you can kind of delegate to them. Those are some great tasks to give to a VA, and that's something that I've done as well, and really offloaded a lot of tasks to that VA. And so again, that creates that capacity for other short-term rentals. You're not kind of deep into every little detail, and allows you, again, to de-risk some of that time that you spend on the short-term rental.
Yeah, so we've really now covered, less cash flow than expected, right? More workload, or how do you reduce the workload of a short-term rental? And we've also talked about short-term rental regulations and how you can mitigate against that. Now, we went into some detail of some of the things you could do, but you can, as you can expect, there's a lot more. And we couldn't cover all of it in this episode. So we wanted to make sure you knew that we have a course called Accelerating Wealth that really focuses on how do you buy and operate a profitable short-term rental? How do you take a property? How do you make sure it's going to cash flow, have cash and cash return, and perform well long term? Because again, the tax savings are great with short-term rentals, but you actually want to have a great profitable short-term rental. That's the goal here, because that's what's going to ultimately be able to help you, replace some of your clinical income. And even one short-term rental can make a huge difference. So if you're interested in learning more about how you can buy and operate really profitable short-term rentals, you definitely want to check out Accelerating Wealth. So it's semiretiredmd.com/accelerating-wealth, and that's where you'll be able to learn about that course. Now, one more final thing we really wanted to make sure we passed along to you is it's really important to know what you're doing when you're buying rental properties. I was just in a Facebook group this morning actually answering a question. It was not our Facebook group, right? Because this would not come up in our Facebook group. It was another Facebook group. And somebody said, hey, I'm selling one of my properties, a long-term rental, and I want a 1031 exchange. I read about short-term rentals. Does anyone know where I can go find one and buy a really great short-term rental? This person clearly doesn't know how to use a cash-on-cash calculator, doesn't have connections, doesn't have a team, hasn't even chosen a market. And this is when you can get into trouble, when you're doing something blindly. Investing has risks, and you want to understand what you're doing. You want to understand how to predict if a property is going to cash flow. You want to know how to put together a really great team. You want to know how to buy a great deal and make it perform better over time. You don't want to do things blindly, because that's when you make these huge mistakes that, kind of affect you down the road. And that's where you get taken advantage of too by people who aren't, necessarily scrupulous, and they see an uneducated person saying, hey, I'm going to buy a property and not knowing anything. and it can really get you into a bad situation. So we really wanted to emphasize you need to know what you're doing when you're buying rental properties. Make educated decisions, understand cash on cash calculators, and we have a couple of them for free at semiretiredmd.com too. So you can get our long-term rental cash on cash calculator and our short-term rental cash calculator for free. Start practicing, learn this, and definitely join us for some of our programs because you don't want to be doing this blindly. One of our mentors talks about paying the dumb tax. And the dumb tax is a mistake, and a mistake can set you back decades potentially financially. So don't make those kind of mistakes. Educate yourself and go out and buy really great deals. If you enjoyed this episode of the Doctors Building Wealth podcast and are interested in short-term rentals or know somebody who's really interested in growing a short-term rental portfolio, make sure to pass along this episode and also leave us a review, and we'll see you next time on Doctors Building Wealth.